Welcome back to the Deep Dive Talk Tickers edition. We are diving straight into the Taylor Morrison Q3 2025 earnings call summary. And this quarter presents a real strategic puzzle for you, the investor.
It absolutely does. I mean, on paper, they delivered headline beats, EPS, revenue, all looking pretty clean. The financial discipline was definitely there.
Right.
But if you tracked the market reaction right after the call, I mean, the price action was incredibly volatile.
Yeah. All over the place.
Exactly. And that immediate fluctuation signals this massive internal debate in the market. Are we rewarding the current financial engineering and operational efficiency? Or are we punishing the forward-looking concerns about demand and that shrinking backlog?
That's the tension we really need to unpack today. So our mission here is to cut through those numbers, extract the core operational gymnastics they're performing right now, and analyze that crucial 2026 growth outlook that seems to have driven the market's polarized reaction.
Okay, let's start with the hard numbers, the headline beat that kind of kicked things off.
Adjusted EPS came in at $2.11.
Now, that didn't just meet consensus, it significantly beat the range, which was, $1.93 to $1.96. So we're talking about a 9 to 10% positive surprise on the bottom line. Pretty substantial.
Okay, yeah, a 9 to 10% beat on EPS, that is massive. So if the financials were looking that clean, why did we see that immediate sort of gut-wrenching volatility? What was the counter-argument from the skeptics right away?
Well, financials were strong, yes, but the overall top line was maybe less thrilling. Revenue came in at $2.096 billion. Now, that was ahead of consensus, too.
Right.
It was still down about 1.2% year over year. So the market pretty quickly focused on how they achieved that bottom line beat.
And the how is really the story of efficiency, isn't it?
Okay.
Management seemed proud to state they met or exceeded guidance on volume, price, and margin. The reported home closings gross margin was 22.1% or adjusted 22.4%, just slightly ahead of their guidance.
Exactly. But here's the core of that financial engineering you mentioned. SG&A leverage.
Oh.
That's the engine here. SG&A dropped 80 basis points year over year, landed at 9.0% of closings revenue.
80 basis points is quite a bit.
It is. And this aggressive cost discipline, that's the financial cushion they needed, really, to absorb the inevitable weakness they're seeing on the front end of their business, the orders. This isn't just like routine belt tightening. This feels like strategic cost cutting designed specifically to protect profitability while they navigate what's clearly a lower volume environment right now.
Okay, so that SG&A leverage provided a profitability buffer, but now we have to transition to the demand side, which is likely why that market skepticism crept in so fast. Let's talk orders and that shrinking backlog.
Yeah, that's definitely the major headwind everyone's watching. Net sales orders were 2,468. That's down nearly 13% year over year. That's a pretty sharp decline in sales pace.
Ouch, 13%. And the backlog, which is, that crucial visibility into future revenue, that's much thinner now, too.
Much thinner. The backlog value fell to approximately $2.3 billion, and that represents a really sharp 39% decrease year over year.
Wow, 39%.
Yeah. And we also need to note the cancellation rates. They came in at 15.4% of gross orders.
15%. Okay, that's a decent chunk. But didn't management make a specific point about their customer base being higher quality, something about filtering?
They did, yeah. They stressed that 15.4% is actually still below industry averages.
Mm-hmm.
And the key filtering mechanism they pointed to is their customer pre-qualification process. And get this, a robust average customer deposit of $45,000.
$45,000, okay.
Right, that's a serious commitment. So that tells you they're likely dealing with highly committed buyers, not just casual shoppers who might bail if rates tick up a quarter point.
Mm.
It seems like they're deliberately filtering out the window shoppers, you could say.
That's interesting context. Okay, let's unpack this operational flexibility piece. This is where it gets fascinating. How are they using sheer speed to try and offset that softer backlog? They talked a lot about cycle time improvements.
Yeah, they've really leaned into this. They realized further sequential savings in Q3, making them roughly 30 days faster than just a year ago. And phenomenally, 90 days faster than 2 years ago.
90 days faster.
90 days. They're essentially back to pre-COVID building speeds, which is quite an achievement given all the supply chain stuff we've heard about.
And the speed, this creates what they call the spec bridge.
Mm-hmm.
Can you explain what this means for you, the investor, watching their revenue timeline?
Right, the spec bridge.
Mm-hmm.
Because they can build and deliver homes so much faster now, it gives them massive flexibility. They can basically start and close homes much later in the cycle. We're talking, potentially starting homes well into next July or even August for a Q4 2026 close.
Huh.
This essentially buys them an extra quarter, maybe more, of reaction time next year. It gives them the flexibility to launch those new communities they're talking about and react to market demand as it happens without having to wait, say, a full year for pre-build revenue to finally show up.
That operational pivot, then, is really anchored by their current inventory mix, right?
Correct. Their current sales mix is roughly 70% spec homes and only 30% TVB or be-built. Now, they acknowledge this means Q4 is expected to see a higher penetration of spec closings.
Okay.
Which does create a modest gross margin headwind. They actually guided Q4 margins down slightly to 21.5% because of it. But that seems to be the cost of capturing immediate volume and maintaining that revenue pace in this environment.
Got it. Okay, let's look at the customer side then. If affordability is the big issue, what are the specific tools they're using beyond just like a simple price discount? They mentioned deploying innovative and compelling incentives. Sounds like marketing speak, but what's under the hood?
Yeah, it's actually pretty interesting. Sounds highly personalized, and it's mostly oriented around financial services. So it includes things like adjustable loans, conventional and FHA buydowns.
Sure.
But the headline innovation, the really new thing, is a proprietary 9-month forward rate lock program. And this is specifically for those TBB homes.
A 9-month forward lock. Wow. That's got to be huge for buyer psychology, right? Especially with rate uncertainty.
Exactly. Buyers know they can lock in a rate now and, actually sleep at night while the house is being built, instead of just praying rates don't spike between groundbreaking and closing day. And get this, about 35% of their total incentive mix is tied specifically to these financial services.
45%.
Yeah, which really reflects just how much the current affordability pressure is about the monthly payment, maybe even more than the sticker price itself.
And that incentive structure, it has to be targeted, I imagine, because their customer base isn't just one single group.
Oh, absolutely. The segmentation is crucial. So entry-level buyers, they make up about 30% of their orders. They require the most expensive financial incentives, like those deep rate buydowns, just to make the monthly payment work.
Makes sense.
But conversely, they're resort lifestyle buyers. That's about 19% of orders. They're apparently much less rate sensitive. For them, they respond more to incentives that reduce the cost of options or maybe knock something off the lot premium. They're just less concerned with the mortgage rate fluctuation itself, it seems.
Okay, so we've seen how they're managing demand using speed and these tailored incentives. But all this flexibility, it seems like it's anchored by their commitment to capital efficiency. Let's smooth the transition here and talk about the balance sheet engineering and this whole shift to being asset light.
Yes, this strategy is really central to their whole valuation thesis, I think. They currently control 60% of their, frankly, impressive 84,564 lots off balance sheet. That's done via options or JVs mainly.
60%.
60% now. And they're moving aggressively toward a 65% target. The whole point is to minimize the capital they have tied up in assets that aren't generating immediate returns, land just sitting there.
And they're playing offense on their existing pipeline of land too, right? It sounds like they're playing hardball on some existing land commitments.
They absolutely are. The investment committee, they said they reviewed nearly 3,400 lots for deals that were already in motion but maybe hadn't fully closed.
Wow.
And these renegotiations apparently resulted in an average 8% price reduction. And they managed to get 6-month deferrals on some of these deals too.
So wait, they took an 8% haircut on deals now, which is obviously great for the company long term, but the investor has to wait until 2027 to actually see that margin benefit flow through. How does management sell that long timeline to a market that's clearly volatile now?
Well, they sell it as locking in future profitability. It's positioned as a long-term benefit designed to give investors confidence that the company isn't just managing the present crisis, but actively restructuring the cost of goods sold for 2027.
Yeah.
That's potentially a significant differentiator from peers who maybe don't have that same renegotiation flexibility on their land books.
That focus on capital efficiency also extended to their build-to-rent platform, the BTR stuff. They call these their Yardly projects. What exactly are these, and what was the financial maneuver they pulled off there?
Right, Yardly.
Yep.
That's their in-house brand for these dedicated build-to-rent communities. So what they did was transfer 14 of these Yardly projects, the ones not in joint ventures, into a massive $3 billion financing facility.
$3 billion. Okay.
Yeah. And this move provided $140 million in immediate capital relief. But maybe more crucially, this setup enables their future BTR projects to be developed and constructed fully off balance sheet.
Oh, okay.
Which maximizes efficiency because they aren't tying up their core homebuilding capital. which they obviously need for their main single-family business in these longer-term rental properties.
So if we connect all these strategic shifts, the SG&A leverage, the asset-light land strategy, the BTR capital relief, the clear conclusion seems to be a major focus on returning excess capital back to you, the shareholder.
That's a huge theme running through the call. Huge. They repurchased $75 million worth of stock in Q3 alone, and their full-year target is aggressive. They're aiming for at least $350 million in repurchases for the full year. Management is explicitly signaling, I think, that they see the company's stock as significantly undervalued, especially given the underlying operational improvements and that future profitability they believe they've locked in with those land renegotiations. They're definitely putting their money where their mouth is.
And just before we move to the outlook, a quick note on innovation. They mentioned a new digital initiative, something about AI.
Yes, it's sort of a glimpse into the future of lead generation. They introduced a generative AI-powered digital assistant on their website. And they made a point to say this goes beyond just, like, scripted chatbots. It supposedly provides dynamic, data-driven guidance to prospective buyers online, aiming to improve the quality of leads before a human sales rep ever even gets involved. Interesting angle.
Okay, zooming out then, we have to look at this performance against the broader housing sector. It's been a tough environment out there. The macro winds are certainly blowing against them.
Oh, they are, no doubt. The sector-wide ETFs, like the ITB and XHB, they've seen negative total returns over the last 12 months. So Taylor Morrison is operating against these ongoing affordability concerns, high rates, and even some specific political uncertainty, like those H-1B policy changes impacting non-resident buyers in key growth markets for them, like Dallas and Austin.
Right. So given all that pressure, are they seeing any regional signs of life, any green shoots anywhere?
Yes, they did highlight a few. Florida markets are apparently showing stabilization, and they specifically called out Orlando as having the highest sales paces in the whole country for them.
Interesting.
Texas, they said, remains highly competitive, especially at the lower price points. But management suggested Austin, which has been, severely challenged, might be starting to see the bottom. Cautious optimism there, maybe.
Okay. And the final piece of this puzzle then is that critical 2026 growth outlook. This seems like what will ultimately determine if the market rewards all this discipline we've been talking about.
Yeah, the strategic focus is definitely shifting towards growth for next year. They expect well over 100 new community openings.
100 new communities.
Over 100, yeah, which they say should yield mid to high single-digit outlet growth in 2026. And many of those openings are specifically timed for the crucial spring selling season. So the big question hanging out there is how quickly they can convert those new communities into a replenished backlog, really bridging the gap created by the current softness.
Which brings us perfectly to our favorite segment, the not financial advice segment. This is where we take all the data we've just sifted through and formulate an outrageous, perhaps, but entirely plausible trade pitch designed to capitalize on the structural thesis we just discussed.
All right. So based on this call, the pitch really centers around a structure play. It's focused on that, let's call it guaranteed capital return, and the strategic asset-light foundation they're building. The core thesis is pretty simple. The short-term volume volatility and the soft orders, they're kind of hiding this robust financial engineering happening underneath. The company's commitment to repurchase at least $350 million in stock, that provides an unusually strong sort of floor for shareholder returns, almost independent of the immediate volume picture. Essentially, you're betting on the balance sheet discipline over the near-term sales pace.
Okay, so we're betting on discipline. How do we structure that trade then to try and capture that financial floor while hedging the continued volume risk until those 100 new communities actually start showing real results maybe next year?
Okay, the idea is to implement a collar strategy, and you do this ahead of that 2026 community opening cadence really kicking in. Think of it like buying insurance for your stock position by selling off some of your potential lottery ticket upside.
Okay, buying insurance by selling the lottery ticket. I like that.
Right, so you buy the shares, that's your long position, and simultaneously you sell an out-of-the-money call option. Now, that call limits your maximum potential profit if the stock really rips higher, but it generates cash, a premium.
Got it.
And you use that cash premium you just received to finance the purchase of a protective put option below the current price.
So just to clarify, we're capping our potential upside with the sold call, but we're using the money from selling that call to pay for downside protection, the put, just in case the market or the housing sector gets significantly worse before those new communities hit.
Precisely. You've got it. The goal here is to capture the EPS accretion that should be driven by that massive buyback program that provides support kind of regardless of the immediate sales pace. But the downside protection, the put, is critical, acknowledging that the market might need to see the actual spring selling season data, so think Q1 or Q2 2026, to fully appreciate the value of those 100-plus new community openings.
And the risk mitigation built into this specific trade idea, it relies on that explicit $350 million plus buyback commitment and the fact that 60% of their lot control is off balance sheet already. That structure, theoretically, limits the extreme downside compared to peers who might be relying purely on volume growth right now. That is a truly complex but interesting bet on discipline over pace.
It is, yeah. And it's a strategy really designed for the kind of tension we're seeing right now. Strong back-end financials clashing with weaker front-end orders.
So to wrap things up for today, Taylor Morrison delivered strong financial results, really driven by efficiency, that SG&A leverage, and some smart capital discipline. They expertly offset the undeniable order softness with strategic operational flexibility, namely that building speed and the asset-light maneuvering.
Which leaves us with an important question for you, the listener, to kind of mull over. How quickly will the market actually reward this shift to the asset-light model and those pretty impressive operational gains? Or will it remain skeptical, waiting until that $2.3 billion backlog is actively being replenished by those 100-plus new communities opening throughout 2026?
Definitely something to keep a close eye on as we move into the end of the year. And please remember, this discussion is strictly for informational purposes only. It is absolutely not financial advice. We just summarize the data points from the call. Go read the transcript yourself, analyze the source material further. We'll see you on the next deep dive.